Welcome back. A 2% inflation target from the U.S. Fed may seem unrealistic to many investors. Our next guest, however, believes that disinflation is a very possible scenario in the first half of 2023, especially considering the strong services sector and changes he's seeing there. For his take on inflation numbers 6 months from now, we're joined by Jeff Weniger. Jeff is head of equity strategy at WisdomTree Asset Management. Jeff, you write blogs regularly on the WisdomTree website, and you begin the blog in question with this sentence: "My mind is on July the 12th, 2023. Why so?"
Well, that's when the CPI report comes out for June, which is my best guess as to which CPI report in calendar 2023 may show the most tepid numbers. You know, when I was getting ready for the call here, I heard you in the background as you went through the morning monologue there, and I was thinking about all the commodities and markets talking about, Paul, and gold is going up. That's one thing that's going up. Stocks have been going up a little bit in the last, call it 3 months or so. I guess Bitcoin has popped off the bottom, but start naming some things that are going up in price. And they're few and far between. I mean, we have in the United States the biggest asset and the biggest push on the CPI numbers, which were home prices. Home prices have been declining, and it's oftentimes by a couple percentage points per month. This has been going on for 6 months or so in the United States. Rents are down. People don't realize that, but rents in the United States are down. We have a crash in used car prices, and used cars were that thing that everyone cited in the CPI report. I mean, if everybody wants to hang their hat on eggs, because we've got this egg shortage going on, eggs are not going to move the CPI. What's going to move the CPI are these owners equivalent rent numbers, rent, used cars. We've got many, many signals of deflation. And I would point out here, Paul, this is very critical. You know, we stopped as a society collecting M3 money supply data, but the OECD still does it. And M3 in the United States, which is the broadest measure of money supply, tell me if it's going up, tell me if it's going down. It's down 1.37% over the last 6 months. We have no precedent. I look at these charts all day. It's data back to 1959. We don't have any precedent for that. That is a money-sucking sound. We have a distinct possibility overshooting the 2% target on the Fed's PCE and also on the CPI. Call it mid-year.
Jeff, are you calling for disinflation or de-inflation? They, of course, are two different things. Disinflation is a contracting pace of inflation. De-inflation is actually prices declining on an absolute basis.
There's a distinct possibility that one of these reports in the second quarter on the CPI could show a year-over-year that is in deflation, outright red ink. Now, whether or not that ends up holding is another thing, because it's a function largely, Paul, of the comps. We are rolling off and have rolled off 6 months now of pretty big month-over-month leaps, and the last 6 months have been tepid. And so that's why it's the June to June one that is a real focus. Now, thereafter it becomes more difficult to maintain outright deflation. But we have a series of all of the issues that were confronting us and sending our inflation numbers here in the United States north of 9 have largely resolved. If there was 2 or 3 stories going on, and one of those were the supply chain, well, the Harpex shipping index is down, 70%. You know, you were earlier talking about crude oil. Crude oil was triple digits back then. It's no longer triple digits. I mean, still $81 or whatever you said there on West Texas Intermediate. It's relatively high, but look at unleaded gasoline. Here in this country, last summer we were at $5 a gallon, and now it's $3.30 on unleaded. This is now, at least in terms of year over years, this is deflationary.
Okay, let's bring up a couple of graphs that you have brought to us that you say buttresses your case. Here's an interesting one. This shows the history from 1993 to the present of peaks in the Fed funds rate. So this shows us Fed tightening cycles and when those cycles ended. And that's the white line that viewers are looking at on this graph. And the yellow circles on the white line are those peaks in the Fed funds rate after tightening cycles, at the conclusion of tightening cycles. The blue line is the Institute of Supply Management Services PMI. So it's prices paid by providers of services in the United States. And what is the relationship here, Jeff, and how does this support your case?
Yeah, I think when we published the chart, it had been at 56.5. We subsequently got a 49.6 because the blog I wrote a few weeks ago, and I think
Right. So that in very short, that means that blue line at the very right edge would be pointing more steeply down to 49. Yeah. Viewers see it now at about 55. It would be jagging down to what 49. Go ahead, Jeff.
And I'll tell you what, Paul, I think it's headed lower. I think it's headed lower. Not only is the end of a Fed tightening cycle operating as something of a lead time on services PMI, as it historically has. Unfortunately, we only have the services PMI data back to the late 1990s, but it tends to give you a lead. It could be 6, 12, 18 months before you carve out a bottom on that one. And a similar metric, and this is particularly notable, and this will not be appearing on the screen here, is if you take a gap between the 30-year long bond and a 3-month bill, correlated concept because the 3-month bill is kind of like the Fed funds rate. We are what now, Paul? 100 basis points to the inverted on that when you take a gap between the 30 and the 3-month bill. And what that will oftentimes give you is a lead time that can be anywhere from a half a year to several years, 2.5 years, before you end up bottoming out, whether it's an ISM services PMI, a manufacturing PMI, or various activity measures. This lends credence to an argument where it's not even in 2023 that we see these things bottom in the low 40s or something like that, but we could be waiting until 2024. And Paul, one of the things I'm looking at this market, I've been saying it for a while here, the 10 years that just ended with that bull market had high PE stocks. The 20% of stocks that were the highest PE beat the 20% that were the lowest PE by an order of magnitude over 10 years that exceeded the 10 years through .com. And if we're going to be sitting here battling in 2024 with punk economic data and a recession that maybe is just lingering into next year, it's only January of 23 right now. If that's the situation, you really have to start questioning whether or not this high PE to low PE switcheroo, which has been going on for only 1 year, has fully run its course. I think we've got several years on this value trade on account of I'm not seeing very much economic data that's promising to me.
Okay, we're at the end of our time for this segment, but I do want to bring up the other graph that you provided. This actually deals with cement production in China. You know what the graph shows. You got to be really quick here. Give us 20 seconds on what this is telling us.
Okay, really quick, the whole thesis for inflation coming back up would be this China COVID reopening. It is promising. I'm excited about it. Everybody is. We got this visions of Chinese consumers buying handbags in Parisian shopping malls. That's wonderful. However, let's not forget what you're seeing in the cement production is a very real situation. We are unwinding a property bubble in China. That is not changing anytime soon.